In this lesson, you're going to learn how to make some of the key income statement and cash flow statement modifications that will be necessary to properly reflect our debt schedules and to make sure that our more advanced LBO model is linked properly. So on the income statement, most of these adjustments are going to be in the form of 4 items. We have the depreciation of the PP&E write-up, the amortization from the newly created intangible assets, the amortization of financing fees, and then the interest income or expense. So we have to properly link in or calculate all these items and make sure they're reflected on our income statement. So let's start with the depreciation and amortization items here. So for the depreciation of the PP&E write-up, we're going to go up to our goodwill and purchase price allocation schedule, take the PP&E write-up amount, and then divide by the period. So 284 divided by 8, in this case giving us 35. I'm also going to anchor both of these so that we can more easily copy it across. Now for the new intangibles amortization, we're going to do a similar thing. We're just going to assume straight line amortization, just like we assume straight line depreciation for the PP&E write-up. And we're going to go up to our purchase price allocation schedule, take this intangible write-up amount, and then divide by the amortization period of 5 years. I will anchor both of those once again. And then we're going to do the same thing for the financing fees. So let's just go up to our purchase price allocation schedule. And in this case, actually our capitalized financing fees are under sources and uses. So we're going to pull the capitalized financing fees from there and then divide by the period of 5 years. And again, I'm going to anchor both of those. So those are in place, and I'm going to copy these across now. I'm also just going to go and quickly check our pre-tax and operating income formulas to make sure these are properly being taken into account. So for operating income, we're subtracting the sum of this entire area for these non-cash charges. So it looks to be working correctly, and we see that, as expected, our operating income here has fallen by a significant amount, mostly due to this new intangible amortization number that we have listed here. Now for the interest income or expense, we're going to go down to our debt schedules and simply pull this net interest income or expense number from right here. Note that we are already including cash in this calculation. It's the only positive on here. And even though the paid-in-kind loan, even though this is not cash interest, we are still including it on our income statement, which is an important point to make. A lot of people mix this up, but with paid-in-kind loans, even though the interest is non-cash, you still count it as interest expense on the income statement, and then you simply add back the interest expense on the cash flow statement. It's a non-cash charge, just like amortization, depreciation, or stock-based compensation. So we're going to pull in this net interest income or expense number. We see that, as expected, our pre-tax income has fallen dramatically in this case. And we'll just copy this across. So now we have the basis for our modified income statement. And this is really pretty much it as far as our income statement modifications. This one's fairly straightforward because most of it we've projected previously, and the few additions we are making are pretty straightforward. We're just dividing a few numbers here by the amortization or depreciation periods or linking in from elsewhere. So now to go to the cash flow statement. So for the first few items here, depreciation and amortization, we are going to link to our income statement directly because we've projected the items there. So depreciation, I'm going to go up to our income statement. We see intangible amortization and financing fee amortization are listed directly below that. So I can actually just copy and paste this formula across this entire area. We can see that we're adding back substantial non-cash charges here, especially this intangible amortization number. Now for the accrual of the paid-in-kind note, so this goes back to what I was just referring to before, that with paid-in-kind loans, you reflect the interest expense on the income statement, but then you add it back on the cash flow statement because it's a non-cash expense. Remember that with paid-in-kind loans, all that happens is that your principal increases over time. So rather than being paid out in cash, the interest expense simply accrues to the principal of the loan. So to get this number, we're going to go down to our debt schedules, and we're going to pull the interest on the paid-in-kind loan directly from here. We also need to change the sign here and make this a positive, so I'll do that. Now I will copy this across. So we have that in place. We don't have any changes to the operating assets and liabilities section here. CapEx will also stay the same. So the next relevant section here is what happens to debt and the repayment of debt in this transaction. So for this one, let's think through what would actually happen here. So for the revolver, we know that basically two things can happen. We can either draw on the revolver and borrow more money, especially if we have a zero balance to begin with, or on the other hand, we can actually pay off some of the revolver. So we need to account for both of those possibilities here. So let's go down to our debt schedules. So if there's revolver borrowing required, that means that our revolver balance will go up here. If debt goes up, debt is a liability, so our cash flow goes up. So we're going to make sure that any revolver borrowing carries with it a positive sign here. So we have that. And then any debt payoff will carry with it a negative sign because paying off debt requires cash. So I'm going to subtract the optional debt repayment for the revolver. Now for term loan A, we're going to go down to our debt and interest schedules again. And for term loan A, we don't have any additional borrowing for term loan A as we do with the revolver, but we have instead our optional repayments and then mandatory repayments. So I'm going to get the mandatory debt repayment right here and then subtract the optional debt repayment. I also want to change this so that the mandatory debt repayment has a negative sign in front of it as well, because both mandatory and optional debt repayments, any use of cash for repaying debt in this case, will have to have a negative sign because it requires cash to actually pay off debt. So both of these should have negative signs in the cash flow statement. And I'm actually going to copy down the formula for all the other types of debt. Copy it down and copy it across. And we can go back and check and make sure that everything's linked in, but I set it up purposely this way so that we could just copy these formulas around. It looks like everything is flowing in correctly here. We also want to make sure the revolver is properly copied across. I'll do that. And then for the total cash flow used to repay debt here, I'm simply going to add up these numbers. And we see that in each case here, our net change in cash and cash equivalents is 0 because we're assuming that all of our cash flow is being allocated toward the mandatory and optional repayments of term loan A and term loan B here. Of course, this will be changing as we further develop this model, and especially in the next lesson when we start linking together everything on the balance sheet. But for now, this is a fine scenario to have. At least we know that nothing in our model is broken the way this is set up right now. So this will be changing. And as I said before, the mechanics of this and the debt schedules and the cash flow statement, the mechanics are all working correctly right now, but the actual numbers are completely off because we have not yet linked in the balance sheet, and ultimately everything is going to be flowing from there and how the debt changes on there. So coming up in the next lesson, we'll be doing exactly that. We'll be getting into the balance sheet, linking everything together in there, and making sure that all these changes to debt are properly reflected on the balance sheet. And we'll conclude by linking together everything in our LBO model and making sure that this more advanced model works properly.